Welcome to our latest market update, the Everything Bubble. I'm Noah Dreyfus, CIO of Dreyfus Capital Management. Today we're going to break down what's driving the markets, the risks that nobody is talking about, and what investors need to know about the forces shaping the AI-driven economy. Before we get started, let's start with this disclosure. This content is for informational and educational purposes only. It is not intended to meet the objectives or suitability requirements of any specific individual account or to be considered a solicitation for the purchase or sale of any security. You should consult your own experts before engaging in any transaction. Dreyfus Capital Management takes no responsibility in any action taken by investors on their own based on the information in this video. Earlier this year, we highlighted rising market optimism and began reducing equity exposure in anticipation of a pullback. Since then, the market rose sharply before correcting, just as we expected. So we see the market between September 2nd of this year and October 16th of this year rising approximately 9% and subsequently falling approximately 5% through October 29th of this year. At Dreyfus Capital, we sold into strength, trimming approximately 4% of our total equity exposure before the decline. Our goal remains the same: position ahead of the turn, not after. So far this year, the market is up approximately 15% as of the recording of this video. So the question becomes, what caused the market to rise so much this year? To understand that, we have to look deeper than earnings and valuations. Yes, AI adoption accelerated. Yes, companies like Nvidia and Google posted extraordinary numbers. But the real accelerant was liquidity. As we noted in our previous update, the total monetary supply has risen approximately 50% since COVID, despite higher rates. Here we see the total assets of the Federal Reserve rising from approximately $3.3 trillion before COVID to today at approximately $6.6 trillion in July of this year. In turn, we also see that the total monetary supply, or the M2 money supply, which is a measure of the total amount of US currency floating in the global economy, rose from before COVID at $15 trillion to $22 trillion as of July of this year. In addition, the Federal Reserve cut interest rates this year, and the market began to price in a return to easier financial conditions. As a result, assets inflated, and quickly. To really understand the effect that the Federal Reserve has on the stock market and the economy is to understand that markets don't rise necessarily because optimism magically appears. They rise because capital becomes available. And today, AI relies heavily both on capital and debt. As estimated by McKinsey and Company and Goldman Sachs, the total AI infrastructure build-out will cost approximately $6.7 trillion through the year 2030. At the same time, Morgan Stanley estimates that approximately 50% of the AI infrastructure build-out will be funded by debt, whether that is corporate or private debt. Let's take a step back to understand what is required in the AI build-out and why it's so expensive. To build a single data center large enough to power modern AI workloads costs average between $7 and $12 million per megawatt, with standard US facilities hitting 40 megawatts or nearly $380 million per build. These are enormous capital expenditures, far exceeding what most companies can fund organically. So who's financing this? Increasingly, private credit is playing a role in the financing of the AI infrastructure buildout. Private equity, as most may be familiar with, refers to groups of sophisticated investors who invest, buy, and leverage private businesses, much the same way that public market investors do with publicly traded companies. Private credit refers to sophisticated investors who fund the deals that private equity makes with debt. To understand the role that private credit plays in the economy, we must first ask why private credit took over. After the 2008 financial crisis, Congress passed the Dodd-Frank Act. Banks could no longer make risky leveraged loans without holding significant capital reserves. That left a vacuum in the economy. Private equity firms still needed leverage. Corporations still needed capital. Data center buildouts exploded in cost. Enters private credit fund. Business development companies, CLO managers, and institutional lenders, a shadow banking system. This system, while essential to growth, is also opaque and nobody really knows what's inside of it. Similar to before the 2008 financial crisis, pension funds, insurance companies, and endowments are always seeking to invest the capital they receive in premiums from their investors into instruments that can generate a high yield. Institutional allocators like these pension funds and insurance companies and endowments that once bought bank loans have now rotated into private credit seeking 8 to 12% yields with low risk. This flow of capital fueled both the leveraged buyout market and the AI infrastructure boom through today. But now, as we're seeing, cracks are emerging. The market began waking up to a key question in October. Is AI being funded by real demand or by vendor financed circular capital? In order to understand this and put this in context, let's take a look at the stock of Oracle. But before we do, here's some context. In the late 2010s, Oracle bought a company called Cerner for $28 billion. Oracle then decided to get into the cloud infrastructure business and compete with AWS, which is owned by Amazon, Microsoft, and Google in cloud processing. In order to do so, Oracle issued tens of billions of dollars in debt. Now let's take a look at the stock. You'll notice in September of this year, Oracle stock jumped 36% in one day. That was based on the news that OpenAI, an unprofitable company that most of us are familiar with, committed to $300 billion in future spending with Oracle. What you see subsequent to this is Oracle shares progressively dropping from the peak at over $300 a share to now about $200 per share. This coincides with the market realizing a fundamental fault point in the AI thesis. Can OpenAI afford a $300 billion contract with Oracle with only $13 billion in unprofitable annual revenue?
With all that said, OpenAI's revenues are still a reported $13 billion in 2025. And Sam, on your live stream this week, you talked about this massive commitment to compute, right? 1.4 trillion over the next 4 or 5 years with, big commitments, 500 million to Nvidia, 300 million to AMD and Oracle, 250 billion to Azure. So I think the single biggest question I've heard all week and hanging over the market is how can the company with 13 billion in revenues make 1.4 trillion of spend commitments? And you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just enough. People are. I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself. Including myself.
People who talk with a lot of breathless concern about our compute stuff or whatever that would be thrilled to buy shares. So I think we could sell your shares or anybody else's to some of the people who are making the most noise on Twitter, whatever, about this very quickly.
Digging a little deeper and understanding how OpenAI is funded and how they can make these large commitments, we come to a diagram here, which describes kind of a circular financing method that's going on in the AI boom. First, Nvidia and Microsoft invests in OpenAI. OpenAI then uses that money to buy Nvidia GPUs and contracts Oracle for AI processing. But OpenAI doesn't have the full $300 billion to pay Oracle with the many expenses that they have and operate. In order to build out the infrastructure that OpenAI needs in order to fulfill its contract with Oracle, Oracle borrows tens of billions of dollars in debt to build this capacity. Doing so causes Oracle to buy a large amount of GPUs from Nvidia. Nvidia then reports massive revenue increases. This looks increasingly like capital routed in a loop from Nvidia to OpenAI to Oracle back to Nvidia, rather than traditional organic market demand. This process seemingly looks like vendor financing. However, vendor financing, where the vendor or the seller of a product finances the customer in purchasing that product from the vendor, essentially round-tripping the revenue, assumes that without the vendor, in this case Nvidia, there would be no demand for GPU chips. This argument is verifiably false. AMD, Intel, Broadcom would step in to meet the GPU demand if Nvidia were to shut its doors to new orders and stop funding the AI complex. The question then becomes, why is Nvidia investing in OpenAI, creating the sentiment that there is a revenue loop if there is organic demand for its chips? The answer is that Nvidia wishes to be the standard for GPU computing. And by being the standard for GPU computing, they can have elevated pricing for GPU processing. Nvidia invests in its customers so that it can ensure CUDA, its software coding framework, remains the standard code base and thereby retaining its customer. If that's true, why is the market getting scared? To answer this, we must understand things in context. Nvidia recently posted blockbuster earnings showing 62% revenue growth year over year. This would normally cause the stock to jump. What in fact happened is that the stock jumped and then fell 9% intraday. Why did that happen? Buried in the earnings report was a small detail. Nvidia's collection period was extended by 7 days. This means that Nvidia was expecting cash to be delivered by customers, and this cash being delivered to pay the accounts receivable was extended by 7 days. To understand the significance of this, we must also understand that Nvidia's daily revenue amount is $626 million. So a delay of 7 days is actually a delay of $4.4 billion in annual revenue. The market instantly interpreted this as a stress somewhere downstream in the AI financing chain, which we know encompasses companies like OpenAI, Oracle, amongst others. If customers are taking longer to pay, liquidity or funding may be tightening. Around the same time that Nvidia revealed delays in payment collections, several major loans defaulted. In the first case, a company called First Brands, which is an autos parts supplier, had $10 billion in liabilities and used an aggressive debt-fueled roll-up strategy to buy other auto parts suppliers, and then filed Chapter 11 bankruptcy. In another example, Tricolor was accused allegedly of issuing fraudulent auto loans and using collateral such as vehicles multiple times against single loans. They then filed Chapter 7 bankruptcy. Another company outside of the auto space called Renovo, which is a home remodeler, announced $100 million in liabilities and less than $100,000 in assets, which is a catastrophic lender impairment. Let's take a look at some comments Jeffrey Gundlach, a specialist in debt, made.
There's something on the Bloomberg Newswire today, it's on Top Go, that speaks of a home renovation business that was private credit, like $150 million issuance of private credit, and it went to zero. But anyway, it's called Renovo or something like this. And now it's very fascinating that this Renovo in the article today, it basically said that they had a Chapter 7 filing and bankruptcy filing, and their their liabilities were listed as being between $100 and $500 million. You check a box. You don't give a specific number. Their assets were listed as less than $50,000. Less than $50,000. Are you trying to tell me that these big private equity firms and private credit firms, with all of their resources, aren't aware of that type of debt to equity ratio that's obviously far into a bankrupt situation? So what's going on here, that private equity firms had this marked a few weeks ago at 100, when it was obvious that their liabilities were vastly, vastly higher than their equity. That should have been marked down to, I don't know, 50, 20, 5, 1, but it's at 100.
What Mr. Gundlach is explaining is that there is a lack of transparency in the private equity and private credit markets, where assets or liabilities held by these companies are not what's called mark to market, in the sense that their values don't have to be reported unless there's a major default or bankruptcy filed. Private companies don't have to report the losses on privately held assets to the market in a process called marking to market. They only have to disclose once a major credit event has happened via the bankruptcy filing. This issue with Renovo had an effect on a major public company called BlackRock, which faces 100% loss on the private loan they issued to Renovo. The real risk to the market that no one is really talking about is one of the most dangerous practices used today called extend and pretend lending, where private credit funds quietly restructure loans by offering special terms to borrowers to avoid default. These include extending maturities, eliminating payments on the debt, capitalizing interest and rolling it back into the loan, or offering payment holidays, all to prevent a formal default or bankruptcy filing. This hides the true health of borrowers and masks liquidity stress in a system increasingly becoming a fundamental core of the economy. If lenders suddenly stop extending credit, AI buildouts, data centers, and the companies building them would face serious strain. The good news is it's not all doom and gloom. If liquidity remains strong and the Federal Reserve eases interest rates, the AI infrastructure buildout can continue without interruption. AI is not a fad. It is not like the dot-com boom, did not create companies without revenue and profit. It's a secular trend comparable to the eventual maturity of the internet. The productivity gains from AI will be enormous, but the winners and losers will shift dramatically. How can investors position now, knowing the risks in the market, but knowing that ultimately AI is not a fad? This moment calls for balance. Investors should not fully exit AI exposure. The upside is generational. Investors should also not be over leveraged or overweight in the highest multiple names. We can reduce exposure where valuations are disconnected from free cash flows, understanding that liquidity is the ultimate issue that the market is facing. We can then reallocate that capital to companies trading at reasonable price to earnings multiples with strong free cash flow and profits to hedge against a liquidity crash. These firms outperform during liquidity crunches and benefit when monetary conditions normalize. To conclude, the AI boom is powerful and real, but the financial system supporting it is showing early signs of strain. Liquidity is abundant, yet fragile. Private credit is strong, yet stretched. And valuations in many parts of the market have run ahead of fundamentals. Success today requires discipline. Stay invested in AI's long-term growth, but hedge with quality free cash flow businesses that can survive a liquidity contraction. Also, stay away from companies that are over-leveraged with debt. If liquidity or the flow of cash is the emergent issue affecting markets, high free cash flow companies and highly profitable companies is the solution. This is how long-term investors outperform. Thank you, and with much success, Noah.